and I'm excited to start with the topic of what happens when your RSUs or your restricted stock units are down. The question is, did they vest already, right? So did they vest and then go down?
Let me give you some background. So I'll keep it super, super simple. Anyone can relate to this. I had a call with some prospective clients. They're mid-career. They have a lot going on. They have demanding jobs. They have kids. They have houses. A lot of things that people have.
I know. When I hear this thing, the first thing I imagine is like they forgot.
No comment on whether or not they forgot, but regardless, they had significant equity compensation in the form of restricted stock units. And over the past however many years, instead of selling them, they let them ride. And in retrospect, when you look at charts or you occasionally glance at account values, for a long time, that was a good decision, right? They were a part of companies whose share prices appreciated. When they talked to me this year, that had been reversed. So they had some high watermark of what the total value of what their combined shares were worth, and they are now significantly under this. Ostensibly, they're at growth companies. Growth companies are getting punished, as you probably know if you've been paying attention to markets. So the question that I pose to you is broadly, well, first, yes, assume this is vested, right? They have a portfolio of vested shares. What do I do now? We were up a lot. We probably psychologically anchored to that high watermark of what these were worth at some point. Now they're worth much less. What do I do? So what are your first gut reactions to this?
I mean, I get worried when I hear this because essentially when restricted stock units vest, they that becomes income for that person. So that the value of those of that restricted stock basically becomes like, you know, an extra salary or whatever you want to call it, cash bonus. So it becomes income. And the biggest problem is that if companies are not withholding enough, you know, federal withholding, I think is like a 22%, the standard one, right? So if your effective tax rate is like 35% because you're, you know, doing very well, or you and your spouse is doing very well, you have a gap there that you need to fill. And if the stock subsequently, you know, collapses, and you don't have that source of liquidity, but you still have that liability at the original price of vesting. And as a result, it could create this, like, you know, this asset liability mismatch. And so I get really worried about cash flows, you know, for tax purposes, because taxes, you don't pay them until April. And the stock might have vested in, let's say, February of the previous year. And so you have an entire year where like the stock just fell or collapsed. And then now, in some cases, like look at these big tech stocks, 60, 70% down. Like you're probably going to have to sell all your stock to cover those taxes. And that's really unfortunate. And so that's a problem, right? So how do we solve that? And I think there's many ways. And I'm happy to hear what you think is the best way, or like one of the many ways you can solve it, because best is depends on each client situation.
That's definitely a top 2 or 3 concern for me is, hey, did you have a bunch of stock vest last year that was under withheld? That happens all the time. The supplemental withholding that most companies do for most RSUs is 22%. Yes, gap. I've seen that gap many times. I've seen those surprised emails and phone calls. So people are like, what the hell happened? And it's pretty straightforward. You didn't withhold enough compared to your tax rate. So yes, that cash flow issue is a big one. Take me one step deeper though. Assume that, you know, it's now April 27th. Let's assume they filed their taxes and got that part figured out. What else? Think about it from an investor standpoint, right? The portfolio standpoint. We have all the stock. We know what the value is. Say it's in 2 positions, right? And assume those 2 positions are roughly equal, right? You have a few $100,000 of one and a few $100,000 of another. What do you do? What are the considerations?
I mean, obviously, your portfolio is probably going to be unbalanced and pretty much, very exposed both on the employment side and on the stock value side, on the net worth side. So you're super correlated between your income and your stock, your net worth performance. It isn't ideal, right? You want to have a diversified portfolio. You want to be protected in case like something happens to your company, to the company you're working for, that you have, so your net worth is not, riding. You don't want to have the same situation as like the secretaries of Enron had, right? Like where they had their 401k, where most employees at Enron had a large portion of their 401k in the company they worked for. So when it went bust, you lost both a good chunk of your 401k and on top of that, your employment. And so I think that is, from a risk point of view, like an economic on a personal side, that is the main concern.
The data point that I come back to here is that if you comb through stock market returns and you compare returns of, let's say, broad indices like the Russell 3000 or the S&P 500 even, and compare these to a random stock, pick a random stock and assume you're a random person working in a random company and you're not, a special superstar whose stock is destined to go up forever. Most individual stocks, like a one stock portfolio, has such a high likelihood of getting crushed by a diversified portfolio over time that it's not worth owning. It's the most suboptimal portfolio you can own. And that language doesn't really hit. People are like, most suboptimal, whatever. It's gone up for a good bit. No, this is serious. If you stick with holding your RSUs, you're making a bad statistical bet, period. And if it happens to work out in your favor and happens to have gone up for a few years in a row, congratulations. The probabilistic Bayesian way to think about this is that that's a bad bet. And you very likely should not be doing that. And you should not have more than 5%, 10%, maybe 20% of your portfolio in one position. 20% is an enormous bet. We can get into Kelly criterion and, concentrated portfolios and all that. But what we know for sure from studying portfolios is that one or two stocks is a terrible portfolio.
The big question to me is like, when are you sufficiently diversified? And I think that's a very individual question, but also at the same time, from a neutral person out there, from like someone who's like very, very average in a sense, I would assume that the S&P 500 passes the test, right? As a diversified, index.
I think our big takeaway is there's a couple big problems. One of them is withholding taxes. We got to get on that ASAP if you haven't already done that math, and how that affects cash flows and if you're okay there. And the second one is portfolio optimization. Without even looking at the rest of what's going on, it's highly, highly likely that you have a suboptimal portfolio, not only for your future income and its dependencies and correlations with your future stock bonuses, but also the portfolio you own today is probably out of whack and probably needs a rebalance.
I have one more thing to add to that is what can you do to solve the cash flow issue preventively? Is there anything you can do?
You must proactively manage your withholding if you have stock compensation.
I don't know this, right? But like, is there a possibility of asking the company to withhold at the 37% level?
Yes.
And so you get the refund.
It's going to depend on your stock plan administration at your company, whether or not they're able to do that, how tightly they're integrated with payroll, whether your payroll provider is able to get so granular. Like it depends on their big system and all the settings and, whether it works that way. But can you ask? Yes. And should you proactively get on top of that and then review the pay stubs? The pay stubs are where the rubber meets the road, where you can see what actually happened. So those are very, very important.
I personally like two strategies here. One is, and they tend to be on the more conservative side, but this is, of the few things I'm very conservative, have a conservative bias, I would say these are the things. Number one, I think I would recommend everybody to manage the RSUs in terms, like look at your pay stub, make sure that the gap that you have there, at least track the gap between what you should be paying on your RSU income and what is being withheld. And that should in general should be overall for your entire, gross salary. I think that should be, you should be aware of that gap. The second part of this is, if you want to keep the shares, and if that's the case, like if you want to keep the shares, and there's many reasons why you wouldn't want to keep the RSU shares because they've already been taxed. It is basically a decision you're making at the moment that it vests, that you're not proactively, but it's being done for you, where you're saying, I'm getting cash, and that cash is being used to buy shares in the company. That is essentially what an RSU is from a tax point of view. And so if you want to if you really believe in the company, if you want to be concentrated in your company that you're working for, then at least, in my opinion, you should just make sure that at the moment of vesting, you're covered for taxes. So like if you have to sell, just cover for taxes. Don't go all in. Don't
at a minimum, an absolute bare minimum floor. You are not taking a loan from the government to go levered long your company's stock in which you are already concentrated. There's another piece here that is probably out of scope for today, which is the tax consequences of selling, and compared to the diversification benefits of what you're going to own on the other side, right? So you have maybe a target portfolio. Let's imagine simply you want to own the S&P 500 and you own two constituent stocks right now. There's a tax cost to selling those, maybe, if you're up on them. If you're down, maybe not. But there's considerations there of that transition period and how to manage that. But we can talk about that another day.
I wanted to touch upon the markets for 1 second. So moving on, I was looking at a graph the other day, because I'm always worried. If there's one scar I have from 2008, it is the scar of the credit markets basically freezing. And in other words, the implication of that is that companies were not able to refinance their debt, and as a result, if they can't access the markets, they end up in bankruptcy trouble. That is the case. Like, let's say if you're a company and at that moment you're very profitable, but you just have to refinance, a huge amount of debt, and you can't refinance it, and you have to somehow get together a bunch of cash to pay the debt that's becoming due, and nobody's going to lend you the money, then you go bankrupt. And that doesn't mean that you're a unprofitable business. It just means that you couldn't gather cash at that moment. So credit markets freezing is, like, I would say, one of the biggest fears the Fed has, and it's something they're monitoring very well. But I kind of wanted to see what the credit markets were doing, and one sign of freezing up of the markets is when high yield bonds cannot reissue or refinance. And in that case, the yields for high yields start to go up, but it doesn't always affect usually the corporate, better rated corporate debt. So better rated corporate debt usually doesn't have trouble refinancing, but high yields in moments of stress do. And so it makes sense to look at the difference, right? If you see like a gap, like an increasing gap in the difference between both of them, that probably is an indication of credit distress. And so on the top graph here, we're just looking at the yields for each one. Obviously, like you saw in the 2020, you saw a big spike in the yields for everything, but then I guess the Fed intervened, and the yields fell down. Same in 2008. That was a much higher spike. But in the bottom one, you see the difference between both of them. And I think this one is pretty interesting because you see during multiple years, there's stability in the difference. Yeah, there is but trends up and down, but then you have moments of stress. The biggest and most notorious one is the 2008 financial crisis. This was a liquidity crisis. This essentially was a financial crisis. Credit markets froze. And so here you had a big increase in the spreads. In 2020 we saw it too, but right now, even if the stock market has been going down for quite some time now, since February, you had stress in the high growth companies and high value high growth companies. You haven't seen a larger credit spreads.
This is a really important and well studied piece. My favorite person who I've read get into this is Dan Rasmussen. His firm is called Verdad. They have a great research library, and they talk about the high yield spread as a really, really important indicator. Just to zoom out really quick, what we're talking about here is the difference in the borrowing ability between companies that are investment grade, where the market thinks that they're very stable, have great assets, great balance sheets, great business stability, and junk bonds. And junk bonds are issued by companies that might have trouble, that maybe are not on as steady ground. And so what you're telling me is that you're monitoring from a kind of a macro level. Investment grade companies, we know what their interaction with the credit market is mostly going to be like. But if the first domino to fall is going to be companies issuing junk bonds, and that market will react very quickly. And that's perhaps a leading indicator. I think Rasmussen would argue that it is, for a domino effect that can be very, very negative. So we're looking at investment grade and high yield. How does this relate to interest rates broadly? That's a big conversation everyone's having. Hey, interest rates are going up. It's part of the inflation conversation. How does this relate to that? How do you kind of intertwine these two or
you will definitely see on the top part, which is the yield of corporate debt, the index, right? That the index of yield. They're both going up. It's just they're going up together, and as a result, the spreads remain stable. I would expect over time, as rates go up, that the spread should enhance, because as a percentage, you would imagine that you want, as a percentage of the overall yields, the spread to remain stable, not the actually absolute number. But it just, if you look at the graph for 20 years, you see periods of stability and really periods of things breaking down.
Big distress.
And I remember, I don't know if you remember in 2018, it was 2000, end of 2019 and start of 2019, you saw here that at the beginning, and it started to break down, and the Fed immediately intervened.
Yep, that was the Fed trying to raise rates and the market saying, we don't like it.
I think that was the Fed doing quantitative tightening. I think they started raising rates in 2015, right? You could see here the rate environment was increasing. But yeah, obviously in 2018, the stress created in the high yield markets, you could see here the yellow one just going up very quickly, and the orange one not so much.
And for some historical context, in March or April of 2020, the Fed, in an unprecedented move, started buying high yield bonds, including high yield bond ETFs, literally
Correct.
using cash to buy that yellow line and keep that from going up too high.
Yeah. And I think that's what drove the recovery pretty much quickly. It took a lot of years to recover from 2008, right? To get to, but in 2020, that was a fast recovery.